The stock market is unstable, investors are worried, and the Fed keeps increasing the interest rates. Now the question is, why the Fed keeps killing the stock market? Hi guys, welcome back to Glory Investing Show, and in today's video we'll be discussing this entire stock market situation and what experts are saying about it. The markets are unable to comprehend, according to Jerome Powell. Markets, as well as investors, are mostly scared off by the Fed, and unless Chairman Jerome Powell softens his hawkish stance, there won't be any recovery. Markets will soar once again when he adopts a dovish stance. According to some, that day won't be far off, and investors should indeed be prepared. Bull markets, according to an adage, are destroyed by the Federal Reserve rather than aging. This year, that has most definitely been the case. Recently, the world stock markets were down as investors grew apprehensive about how high central banks would raise interest rates to control inflation. The European Central Bank is anticipated to hike its prime lending rate, as that which the Bank of England did on Thursday. On Wednesday, market volatility in the U.S. was visible. Stocks surged at the opening bell as investors awaited a signal from the Fed Chair Jay Powell that the Reserve Bank would soon revert to its program of swift rate rises. Stocks fell when he did the reverse, though Mr. Powell made it clear during his noon conference that additional work has to be done to get inflation to the Fed's target rate of 2%. By the conclusion of 2023, the Fed expects to increase its policy rate of interest to 5.1%. It's set to a range of 4.25 to 4.5% at the moment. After Beijing revealed that industrial production and retail trade for November slipped in below expert predictions as the effects of the country's now largely relaxed zero-COVID strategy have become more apparent, stocks in Hong Kong plummeted 1.6%. According to researchers in Hong Kong, when China alters its policies for combating the virus, there may be close to 1 million COVID deaths. According to reports, Goldman Sachs is allegedly reducing banker compensation by at least 40%. The company is thinking about cutting compensation by the most since the economic meltdown. Some executives fear that such drastic budget cuts, which would be more severe than those of its competitors, could result in a wave of banker resignations. The United States economy expanded. After 2 quarters of contraction, the U.S. economy expanded by 2.6% annually in the third quarter, exceeding analyst projections. This incredibly robust economy defies the Federal Reserve's vigorous efforts to control inflation by stifling growth with high interest rates. However, a closer examination of Thursday's headline GDP figure tells a different tale. The weight of central bank policies is being felt by the property market, which is buckling under the added pressure. Well, the mortgage rates increased yet more, reaching 7% for the very first time since 2002. These rising rates are starting to choke off the housing market since they are spurred by the Federal Reserve's extraordinary campaign of raising interest rates to rein in skyrocketing inflation. According to figures released on Wednesday, sales of newly built homes fell 10.9% in September compared to August, and then dropped 17.6% from a year earlier. The sector-by-sector analysis of third-quarter growth in the economy reveals the intense strain facing the housing market. During June and September, residential investment, a surrogate for both residential construction and home sales, shrank by 26.4% annually, deducting so much from GDP than it had done since 2007. According to Gregory Dacko, chief economist at EY Parthenon, this informs us that we are witnessing a considerable decline in both house purchases and home building. Rising mortgage rates and sky-high house costs have caused a significant decline in first-time homebuyer activity and moved investors to the sidelines. Financial constraints impose restrictions on housing activity and other related activities. What experts are saying. Just 4% of the U.S. economy is made up of residential investment, yet this quarter's dramatic decline had a disproportionately large impact, lowering total growth by 1.37% on average, according to Dacko. He anticipates that this pattern will hold into the ensuing quarter and 2023. We've seen categories that typically have restricted effect on GDP have big effects caused by massive swings, he said. That's one of the cycle's characteristics. The business cycle, according to economists, is the housing market. It makes it reasonable that Fed policy will have an earlier impact on residential prices and sales than other sectors, given the close relationship between the soundness of the housing industry and borrowing costs. But because the housing market is a leading indicator of how the rest of the economy will perform, these contractions will unavoidably hinder U.S. growth. Jim Baird, CIO at Plant Moore & Financial Investors, predicted that this influence will be visible in the fourth quarter of GDP. Families in the U.S. get the majority of their wealth from home ownership, so a decline would result in a significant loss of wealth for the entire nation. Only around 2 weeks before such a divisive primary election for Democrats, President Joe Biden applauded the economic data. In a statement, he said that Republicans in Congress had been rooting for a downturn, and that doomsayers have been contending that perhaps the U.S. economy is in a recession for months. But today we received more confirmation that our economic growth is progressing. However, the study as a whole isn't as positive as the headline figure suggests. This is the result of fluctuating data on international trade driving up overall figures. Although the United States is buying fewer items as demand declines, net exports were robust. In truth, American consumers are beginning to hold back. Spending by households rose by 1.4%, contrasted to 3.0% in the same quarter last year. In the third quarter, to combat escalating inflation, the European Central Bank revealed yet another significant increase in the interest rates on Thursday. This is the rate increase that has occurred at the fastest rate in the historical past of the euro. At their meeting, policymakers also gave a somber outlook, promising more gains in the future and predicting a prolonged economic recession. The change will raise the benchmark interest rate again for 19 euro-using nations to 1.5%. Increasing inflation. The annual inflation rate in the Eurozone increased to a historic 9.9% in September from 9.1% in August. Policymakers had been taken aback by the unexpected and exceptional surge in inflation. ECB President Christine Lagarde told journalists on Thursday, according to her, increases in the cost of retail energy could cause inflation to spike in the medium run. The group is confronting severe economic slumps in addition to pricing increases. Lagarde admitted that the risks to the prospects for economic growth are obviously negative. The third period of this year saw a potentially significant slowdown in economic activity, and we anticipate that trend to continue into the rest of the year and the start of the following one. Amazon stock plunged. In October of this year, Amazon stock plunged 13% after the company reported weaker than expected third-quarter earnings and reduced its expectations for future sales. The corporation issued a warning, noting that analysts' initial projections of $155 billion for the fourth quarter revenue ranged from $140 billion to $148 billion instead. Even Apple was not immune to the big tech scourge. On Thursday afternoon, the company outperformed Wall Street forecasts, but core product revenues, including those of the iPhone business and services, fell short of forecasts. In pre-market trading, shares increased by 1%. Some of the biggest U.S. IT companies' dismal week of earnings comes to a close with Amazon and Apple. In the most recent quarter, Alphabet and Facebook parent Meta platforms missed earnings targets, blaming a weakening digital ad market. Microsoft also announced dismal cloud service revenue and gave mediocre future forecasts. Most independent investors would likely blame the conflict in Ukraine if you asked them what precipitated the stock market crash this year. Though the mood has been battered by the prospect of a worldwide catastrophe brought on by the confrontation with Russia, this is not what caused the market to crash. Others might mention the escalating inflation brought on by the oil shock of this year and the post-COVID supply problems. That's all for today's video. I hope you enjoyed it. If you found this video helpful, make sure you smash the like button and share it with your friends. Don't forget to share your thoughts with us in the comments section below. And while you're here, click to watch one of these other 2 videos appearing on your screen right now. I'll see you there. Take care and stay tuned.